Good afternoon. Welcome to the Monetary Policy Stance and Monetary Policy Report press briefing. Let us welcome the following BSP resource speakers. Monetary Board Chairman and Bangko Sentral ng Pilipinas Governor Felipe M. Medalla. Deputy Governor Francisco G. Daquila Jr. of the Monetary and Economic Sector, Senior Assistant Governor Iluminada T. Sicat of the Monetary Policy Subsector, and Officer in Charge Dennis D. Lapid of the Department of Economic Research. Governor Medalla will now deliver the monetary policy statement.
At its meeting on monetary policy today, the Monetary Board decided to raise the interest rate on the BSP's overnight repurchase rate facility by 75 basis points to 5.0%, effective tomorrow, November 18, 2022. Accordingly, the interest rates on overnight deposit and lending facilities will be set to 4.5% and 5.5% respectively. The BSP's latest baseline forecasts indicate a higher inflation path over the policy horizon, with average inflation reaching the upper end of the 2 to 4% target range in both 2022 and 2023 at 5.8% and 4.3% respectively. The forecast for 2024 has also risen slightly to 3.1%. In deciding to raise the policy rate anew, the Monetary Board noted that core inflation has risen sharply in October, indicating stronger pass-through of elevated food and energy prices, as well as demand-side impulses on inflation. At the same time, the risk to the inflation outlooks lean strongly toward the upside until 2023, while remaining broadly balanced in 2024. Upside risks are associated with elevated international food prices owing to higher fertilizer costs, trade restrictions, and adverse weather conditions. On the domestic front, the impact of weather disturbances on prices of fruits and vegetables, supply disruptions in key food commodities such as sugar and meat, as well as pending petitions for transport fare hikes, could also exert upward pressures on inflation. Meanwhile, the impact of a weaker than expected global economic recovery continues to be the main downside risk to the outlook. Given the increased likelihood of further second-round effects, persistent inflationary pressures, and predominance of upside risks to the inflation outlook, the Monetary Board recognized the need for aggressive monetary policy action to safeguard price stability. With strong growth of the economy in the third quarter of 2022, domestic demand is seen to hold firm owing to improved employment outturns, investment activity, and consumer spending. On the other hand, a sizable adjustment in policy interest rate will help insulate the economy from external headwinds and exchange rate fluctuations that could further entrench price pressures and potentially dislodge inflationary expectations. The Monetary Board is also reassured by timely non-monetary government interventions to mitigate the impact of persistent supply-side pressures on commodity prices, including those aimed at alleviating supply shortages and strengthening farm productivity. Looking ahead, the BSP will continue to take all necessary action to bring inflation back within the target band over the medium term, in keeping with its primary mandate to sustain price and financial stability.
Thank you, Governor. At this point, we would like to request OIC. At this point, we would like to request OIC Lapid to share with us the November 2022 Monetary Policy Report.
Good afternoon. The short presentation summarizes the key considerations that served as the basis for the Monetary Board's latest monetary policy decision. In deciding to raise again the BSP's policy interest rate, the Monetary Board considered the following factors. Firstly, the latest BSP baseline inflation forecasts have been further revised upwards, with inflation settling further above the government's 2 to 4% target at 5.8% for 2022 and 4.3% for 2023. However, inflation is also projected to return to the target range at 3.1% for 2024 as various supply side pressures run their course and negative base effects take over. In the near term, inflation is expected to remain elevated. The latest projection path shows inflation peaking in the fourth quarter of this year and remaining above the target range in the succeeding months. Nevertheless, inflation is also seen to return to within the 2 to 4% target band by the third quarter of next year and eventually approach the lower end of the range by the fourth quarter of next year. This is mainly due to some base effects, and later on will eventually stabilize to the midpoint of the target by second quarter of 2024. The projected deceleration of the inflation path can be attributed to the easing of global oil and non-oil prices and negative base effects from previous transport fare adjustments in 2022, as well as the impact of the BSP's cumulative monetary policy adjustment. Secondly, the risks to the inflation outlook over the next 2 years are seen to be strongly skewed to the upside, particularly for 2023, but are seen to be broadly balanced for 2024. As can be seen in the table on the right, and particularly the last column, there is a higher probability of inflation settling above the upper end of the 2 to 4% government target in government target band in 2022 and 2023 compared to the previous forecast round. The matrix also shows that the matrix on the left also shows that upside risks have also increased. Should these various risks materialize, the inflation forecast will move further away from the inflation target in the near term. As the table shows, the key upside risks to the inflation outlook are as follows. On the external front, the potential impact of higher fertilizer prices, trade restrictions, and adverse weather conditions on global food prices are one of the major upside risks. On the domestic front, the upside risks relate to higher food prices from further weather-related disturbances, transport fare adjustments, and the possible reinstatement of full tariff rates on food imports such as pork and rice that were temporarily lowered under EO 171. Meanwhile, for the downside risk, the impact of the weaker than expected global recovery is continued to be seen as a primary downside risk. Third, inflation expectations over the policy horizon have further increased as well. We here in the slide, we show the results of the latest survey by the BSP of private sector economists forecast for the next 2 years and for this year. The November survey showed a higher mean inflation forecast for 2022 at 5.9%, compared to 5.7% in the October survey. Similarly, the mean inflation forecast for 2023 and 2024 rose to 4.9% from 4.6% previously, and 4% from 3.8% in the October survey round. These November survey results are based on responses submitted by 22 economists from the private sector. In the survey, analysts expect inflation in 2022 to breach the upper end of the government's target range, given that price pressures have become more broad-based, with risks to the inflation outlook also skewed to the upside due to lingering pressures caused by weather disturbances, global supply chain disruptions, the COVID-19 pandemic, the weaker peso against the US dollar, and second round effects. Meanwhile, inflation is also expected to remain above the target range in 2023, suggesting a possible disanchoring of inflation expectations. Nonetheless, as can be seen from the chart, particularly the red line at the bottom, expectations also point to deceleration of inflation towards the upper end of the government's target in 2024. At the same time, the Monetary Board also took note of the continued recovery in domestic activity. Output growth in the third quarter was stronger than expected, driven by robust household spending, investment activity, and strong export performance despite inflationary pressures. With GDP growing at 7.6% year on year in the third quarter, the full year growth for 2022 is projected to settle within the DBCC's target of 6.5 to 7.5% for 2022. Domestic growth is seen to remain robust over the succeeding quarters in view of easing mobility restrictions, stronger capital formation, the return of domestic and foreign tourism, as well as increased MSME activities induced by the resumption of face-to-face activity. Nonetheless, downside risks to growth prospects remain considerable given persistently high inflation, rising interest rates, and the weaker global economic outlook. The full year BSP GDP growth forecast for 2022 and 2023 accordingly have been adjusted upwards from the previous NPR due to the upward revisions in the second quarter GDP, the stronger than expected GDP number in third quarter, and the higher world growth assumption for 2022. Meanwhile, the GDP forecast for 2024 is lower, reflecting weaker external demand as well as the impact of higher domestic interest rates. In addition, the economy is projected to operate at slightly above potential. Staff estimates indicate that the output gap is projected to turn positive in 2023, reflecting largely the sustained expansion for this year. However, the output gap is projected to return to broadly neutral levels in 2024 as the impact of the BSP's policy rate adjustments take hold on the economy. So in view of these foregoing conditions, the BSP has decided to raise the overnight reverse repurchase rate by 75 basis points to 5%, effective tomorrow, on November 18. Some of new information that's become available since the previous monetary policy meeting argued for maintaining the BSP's tightening bias and also sending a firm signal of the BSP's commitment to combating inflation and bringing it back down to target. In particular, the broader inflation pressures, second round effects, and higher inflation expectations constitute the main impetus for a strong follow-through monetary action. A robust policy response can also help against spillovers from tightening global financial conditions. Lastly, firm policy action by the BSP will serve to complement the broader array of targeted responses by the national government, including measures to improve agricultural productivity and address supply-side bottlenecks for key food items. A detailed discussion of all of these factors that were discussed in the monetary policy meeting can be found in tomorrow's monetary policy report, which will be published on the BSP website. In addition, we'd like to quickly note that the report will also include 3 box articles, one on the non-monetary measures to address supply side pressures, an article on the updated estimates of the exchange rate pass-through to inflation for the Philippines, and also a preliminary consideration of the impact of monetary tightening on the Philippine corporate sector. So we hope you'll download a copy and look at the details of the latest report. This ends the presentation, and we look forward to answering your questions.
Thank you, OIC Lapid. We now proceed to the questions that have been sent to us by the press as well as market analysts. For any additional questions or clarifications, you may send your comments through this live Facebook broadcast or send us a message through text, Viber, or Messenger. First, we have a comment from Professor Emmanuel Lopez, Dean of the Graduate School of the Colegio de San Juan de Letran. He said, the current situation of almost nearly a galloping inflation of 7.7% is being attacked on the demand side as proven by the continuing increase in the policy rates, which is forecasted to total to 4% in 2022. These situations seem to indicate that the authorities are resolving the problem via the back door, considering that current inflation is basically supply driven, and the right approach is to cut down production costs and reduce prices and encourage consumer spending. As it is, both consumers and producers are both hard up with skyrocketing interest rates, resulting into a recession. So thank you very much, Professor Lopez, for that comment. Uh, Next, I will read through the questions that have been sent to us. First, from Joanne Villanueva of Philippine News Agency. This is her question. Governor Medalla announced the path of the BSP's key rates this month immediately after the Fed's latest rate decision. What is the BSP's assessment on the results of this transparency vis-a-vis the peso and the financial market in general?
Okay. The first question is, oh my God, the answer is the our policies, even for the government as whole, cannot affect costs. Of course, the exception is where the cost of the high prices are import restrictions, and the government can do something about that. On the other hand, although the the causes of inflation are largely supply shocks, there's a great risk that this will result in self-fulfilling prophecies of high prices in the future. We sometimes use the technical terms for it, such as second-order effects. And this is the reason we have to have a aggressive monetary policy. The other factor is that this is a very unique global situation of uncertainty, and the US dollar has become a very strong safe haven, especially with weak Europe, Japan, and China. And therefore, very small differences in the interest policy rate of the BSP and the Fed could cause to result in a very weak peso, which, if allowed to continue, given that depreciation is already very high to begin with since the beginning of the year, could also trigger disanchoring of expectations, where price expectations are no longer based on BSP forecast and guidance, but on what's happening to the exchange rate. This is the reason we actually use the term aggressive in our press statement. Okay, we cannot afford to allow prices to rise just because people expect them to rise. And the best way to do that is to have tight monetary policy. On the second question of why we chose to announce what we will do now, nearly 2 weeks ago, after the Fed increased its policy rate by 75, I've already mentioned the reason that under the current global conditions where the dollar is so strong, then a large differential, a small difference between the policy rate of the Philippines and the US will contribute to a much weaker peso. So therefore, we deemed it important to announce what we will do so that the uncertainty of what we will do, what we will be doing today, did not affect did not cause too much volatility during those 2 weeks between the policy rate meeting of the Fed and our policy rate meeting. And in our assessment, it worked. Although many forces are were working together, you notice the peso appreciated. Of course, that is not due solely to what we did, but it could be due as well to the fact that the dollar actually also weakened relative to other currencies during that time. But we think it helped. So there are times where it's good to give forward guidance, and these are those times. But in normal times, there's no need for that. And also in normal times, we are not as concerned about uh, the peso dollar rate as long as as long as inflation is within target.
Thank you, Governor. We will now proceed to the second question from Lee Chepongyan of Manila Bulletin. What else can the government do in terms of timely inflation control by non-monetary means to ensure that the target will be achieved by the second half of 2023?
Well, we already mentioned the importance of uh, loosening import restrictions on the products that have become very expensive. As for instance, sugar, a very small part of the basket as a share of the budget, but it contributed a lot to inflation because the increase was just very high. Now, of course, whatever government can do to reduce costs, such as improving the flow, the logistics, will be very much welcome. But in addition, the government can also have, if inflation becomes too high, uh, have targeted assistance to the poorest parts of the population. So I think those are the two things that the government can do. Now, as to suggestions that the government cut taxes to lower the price, it can actually backfire. If they do that and fiscal credibility of the government is reduced, that is, as it cuts taxes while the deficits are already quite large, and therefore credibility of the ability, confidence in the ability of the government to pay its debt is reduced, interest rates will rise, even if we don't raise policy rates. And in particular, the spread between the borrowing cost of the Philippine government and the U.S. government in U.S. dollars could rise. And I'm old enough to remember that there were times when the spread between Philippine government borrowing was 600 basis points higher than the equivalent U.S. borrowing. Same tenor, same currency. And the only reason the rate is higher is that it's the Philippine government that's borrowing. So some of those measures suggested by some are actually counterproductive. Okay, so in summary, the best measures the government can take is where the cost of high prices are import restrictions, it can relax those import restrictions. And in addition, if the poor, to the extent that the government can actually has the funds, it can actually have more target assistance. And the good example of this would be direct subsidies to mass transit.
Thank you, Governor. Next question, also from Lee Chipongyan of Manila Bulletin. Based on your monthly projection, do you see inflation exceeding 8% either in November or December 2022?
This one. What's the question again?
I'll repeat, Governor. Based on your monthly projection, do you see inflation exceeding 8% either in November or December 2022?
Okay. as they say, it's very hard to forecast, especially the future. Okay, so, uh, but I'm willing to bet a lot that it will not exceed 8%. It might, but I think even money, I would bet that it will not. If okay, your 1 peso versus my 1 peso, or your 1,000 pesos versus my 1,000 pesos, the best bet I think is uh, bet on it not exceeding 8%. And then even if it does, it will start going down by the by next year. And our own forecast is that by the second half of next year, inflation will actually be closer to 3 than to 4. Of course, that's assuming that there are no new supply shocks.
Thank you, Governor. Our next two questions come from Lawrence Agabili of Philippine Star. This is his first question. Bank lending grew by more than 13% in September despite the rate hikes. When do you expect the tightening cycle to impact credit growth?
Okay, uh, credit growth is largely a banking decision, and the extent to which there is well, we technically refer to as excess structural liquidity. That is, banks have deposits with the central bank, way in excess of the reserve requirement, and these are in the form of their holdings of central bank bills, which they can sell, their term deposit facilities with the VSP, and the overnight deposit facilities, which right now total above 1 trillion pesos. Then the question is not so much the rate, but the willingness of banks to take on risks. So, so if banks are willing to take on risks, then and there are borrowers who want to borrow even at the higher rates, then credit growth will continue. Now, as to how aggressive the banks will be, there are two things going in their favor being aggressive. I already said that they have quite a bit of deposits with us, money invested in us. But the other one, of course, is their own assessment as to whether they are, as they, for instance, find new borrowers, they are less confident in the new borrowers paying back than in the borrowers they're already familiar with. Okay, so to use a classic term, the credit growth is as much a function of quote unquote animal spirits as it is uh, with the rates, because the current rates compared to our forecast of inflation is not really all that high. For instance, our forecast of inflation for next year is 4 point, how much? 4.3%. The policy rate is 5%. So in real terms, money is still cheap. Okay, so we have tightened monetary policy, but it's closer to neutral than to very tight. So it's not an obstacle to growth, but clearly an obstacle to excessive lending.
Thank you, Governor. For the next question from Lawrence Agawili of Philippine Star, what is the impact of the ongoing tightening cycle on economic growth for this year and next year? I will combine it with a question from Mr. Sanjay Mathur of ANC. He has a question on Philippine growth. Growth in the Philippines has until now not been impacted by rate hikes. At what point do you feel that it will? Or when do interest rates move into genuine territory?
Okay, we still think that the government DBCC growth rates uh, are still attainable, or if one can either look at growth being closer to 6 than to 6.5, or in the higher end of between 5.5 and 6, but growth will still be there. As I said, even after the inflation normalizes, the real rate is not higher than normal, but not very high. And there are other factors, of course, that will affect growth more than the policy rate. For instance, we already know that in the case of the weather, in the case of agriculture, weather is really more important. And in the case of exports, the growth of the economy that we export to and the competitiveness of Philippine prices, goods. So, in other words, the bigger drivers of growth have to do with uh, net exports, and uh, and at the same time, uh, Filipino consumer demand remains strong, and we think that with all the backlog in capital formation during the pandemic, uh, invest demand capital expenditures, or what in the cap in the national accounts are referred to as gross domestic capital formation, will remain strong. So we're confident that in spite of the interest rate hikes that we have done, respectable growth is still very, very feasible.
Thank you, Governor. Our next question comes from Michael Ricafort, Chief Economist at Rizal Commercial Banking Corporation. He asks, what is the impact of higher inflation on economic growth in view of the latest inflation estimates, especially for 2022 and 2023? How does the latest sensitivity analysis look like in terms of percentage points reduction in GDP or the economic growth rate for every percentage points increase in inflation rate?
It depends what the source of the inflation is. If the source of inflation is uh, itself that monetary policy is too loose, then inflation actually is the effect uh, rather than a cause. Now, on the other hand, if the cause of inflation is supply shocks, in particular, more expensive imports, then people who, for some reason or another, must keep on buying the imported goods despite their high price, will have less money for other things. That one will have a big impact on discretionary consumer spending. We have noticed that, for instance, when there was a very high increase in oil prices, the spending on discretionary things fell. So the answer again is it depends. Supply side shocks will, of course, uh, the manifestation of supply side shocks is both higher inflation and lower output. On the other hand, the manifestation of excessive demand is higher output and higher prices. Unfortunately, the second cannot go on forever. At a certain point, the excessive inflation has to be brought down, and that is the one that will eventually be costly to output. So that's why we do not want inflation to get out of hand and be entrenched, because then fighting that inflation will be very, very bad for GDP. Fortunately, we are not there yet.
Thank you, Governor. Next question is from Ms. Eileen Mencias of Abante Bilionario. She asks, will you please discuss the trend you see in consumer loans since the beginning of this year, and how does it compare with the movement of loans to businesses?
I cannot recall. I've seen the data, but I'm not very good at remembering all those numbers. Maybe somebody else can answer that question. What's happening to consumer loans?
Thank you, Governor. So what we've seen is that bank lending has remained broad-based across uh, four industry types. So, by economic activity, real estate has had the largest share of the total loan portfolio at 18.6%. And on the other hand, we've also seen growth in consumer lending. So, um, uh, loans for household consumption have accounted for around 10.7% of the banking system's gross total loans. And growth has been actually robust at 15.1% year on year. And this is actually the sixth consecutive month that consumer lending has grown. That's since April of this year. Thank you.
If I may, DG and also Governor, I will ask a few more additional questions from Aideen. How would you relate this to the movement in consumer loans, to the movement in NPLs? What would be the effect of the lifting of the ceiling on interest rates and charges on credit cards on NPLs and credit growth?
Well, you can see NPS could actually declining. Now, whether increase in loans, whether the increase in loans will result in lower quality loans. In other words, the new loans are of lower quality than the existing. Uh, that is really the question. As the banks find new borrowers, are the new borrowers more risky? And our own experience with Philippine banks is they have developed the skill to find safe new borrowing. So it does not necessarily follow that if they lend more, NPL will rise. Now, the other factor that can cause higher NPL are surprises. That is, people who borrowed thought they were all right, and then they're not. Okay, so when there are big shocks, the layoffs, unemployment, those are a bigger cause of uh, default uh, than simple expansion of credit.
Thank you, Governor. We now proceed to the question of GMA, Ms. Maki Polido and Miguel Aguana. Do you have a projection for remittances for the last quarter of 2022? Do remittances help in stabilizing the peso dollar exchange rate? And what would an increase in remittances indicate?
Well, I will give my general answer there. The remittances are extremely important, but they're no longer a leader in growth, meaning the growth rate of remittances for some time now is lower than the growth rate of the economy. That's for the simple reason that the base is already so high. So when you're already running into what, how many billions now? 40. It's very hard to grow by a high rate. So what I remember is that the growth rate of remittances is now what, 4 to 6%. Yeah,
Lower than 4%,
Yeah.
a little bit lower than 4%, Governor. We're actually still seeing that for the full year, remittances will grow by about 4%. We do not project it on a per quarter basis, but since the year-to-date number is a little bit below 4%, then you can see that the fourth quarter expectations that there will be an acceleration of remittances, and this is actually in accordance with our experience during the Christmas season, especially. You have support for the overseas Filipino families. Thank you.
Well, actually, the amazing thing about remittances is it's so high and yet it keeps growing. And also its extreme resilience to global shocks. I remember during the global financial crisis, I think both the World Bank and the IMF were predicting that the global financial crisis will cause a decline in remittances. And yet the opposite happened. So that's the other thing you can say about remittances. It's large and still growing and still resilient. And the growth is resilient.
Thank you, DG, and thank you, Governor. From Nikki Mapa of ING Bank, given the importance of the exchange rate on the inflation outlook, how does the BSP have an estimate of the impact of aggressive rate hikes on the peso?
We don't really have a model that says if the interest rate is this, the exchange rate will be this, because there are so many things that cause the exchange rate to move. However, what we do know is if the interest rate differential is too small, especially during times when the US economy is the only game in town, then the peso will tend to be weaker than normal. And this is the reason that right now, the US policy rate is a bigger influencer of our policy rate than normal.
Thank you, Governor. A follow-up question from Mr. Sanjay Mathur of ANC. Which part of the BOP do you feel has suffered most from Fed rate hikes? And do you feel that lower infra spending may be more effective in controlling the current account deficit?
Thank you, Governor. Actually, the impact of policy rate adjustments by the Fed would be felt through several channels. Mostly this would be through imports. Now, to the extent that that causes a weakening of the currency, then of course that can cause the uh, current account deficit to go up. But then again, because of the uh, aggressive moves by not just by the Fed but other advanced economy central banks, there's now a higher probability of recession happening in a global output next year. And because of that, the oil prices are what we've seen is a moderation in oil prices. And so that's an impact on the balance of payments that goes in the other direction. Because what we've seen is that for this year, about two-thirds of the movement in imports is attributable to price changes and only one-third to volume changes. Thank
I'd
you.
also like to add, DG and Governor, that we also observed some decline in portfolio investments in 2021 and 2022 as a result of um, financial tightening globally. And with respect to foreign direct investment, we also saw some slowdown in FDI simply because some of the foreign direct investors are staying on the side waiting for what's going to happen in the financial market. Thank you, Governor.
But one would add though that in spite of that, the balance of payments deficit is smaller than the current account deficit. So that means that we still have some inflows to partially offset the relatively large current. It's relatively large because it started out very small. From 5 billion, we forecast that the current account deficit will be what, 20? Yeah, so that's quite a bit of increase in demand and demand for dollars. That's 15 billion, say, relative to let's say the total exports. That's quite high. So so that's the other thing that, of course, we're hoping that during better times, uh, uh, direct investments will be financing much of the current account deficits. On the other hand, the suggestion to cut infrastructure spending to reduce the current account deficit will work immediately because capital goods, capital formation is very important, intensive. The problem that is that our finding is that capital formation increases future output much more than the capital formation. So you'll be sacrificing future output by much more than you are cutting capital expenditure. So we think it's a good idea to continue with the infrastructure program if the projects are good and uh, well implemented. Having been a member of the, well, having been a representative of the BSP in the NEDA ICC, I think the process there is quite good. Uh, if at all, the weaknesses are that projects that look good on paper turn out to be not as good because of implementation problems. But by and large, uh, the, the social return to government infrastructure programs are quite high. Indeed, the cut-off rate of the NEDA is much higher than the cost of money.
Thank you, Governor. We're down to our last three questions. This is a question from Kisha Taasan of Business World. Will the BSP continue to match the Fed's actions until when? And if the Fed slows down next month, will we also slow down? I have a related question from Warren de Guzman of ANC. Can we expect the BSP to continue with its practice of announcing policy adjustments immediately after the Fed rate setting meetings?
Okay, again, the typical answer to that is everything is data dependent. Uh, yes, it's not normal that we have off-cycle policy rate increases. It's also not normal that the central bank governor announces what the rate will be in the meeting that will come 2 weeks later. Okay, those are all rather abnormal or unusual. Uh, Now, the things that cause them are also unusual, and I think they will not be repeated. For instance, they're now talking of the Fed making smaller increases. So, and also to the extent that policy rates are also rising in Europe and in other countries, then the US dollar is no longer going to be as strong as, will not appreciate as much as he used to. So given that, we cannot say beforehand that we will repeat uh, the the last increase, which was the last two increases essentially were largely responses to what the Fed did. That is, to be more clear, perhaps our policy rate increases would have been smaller if the Fed's increases were smaller. Fortunately, the period that we expect the Fed to make, what's that? How many 75s? 475s in a row? 475s in a row. I was looking at some news, and the Fed rate now is not the highest, but the 475s are the highest rate of increase for a long time. And I think that's over, and therefore we're slowly going back to a more normal global interest rate environment. And therefore we will probably do less of the two recent unusual or not run of the mill action that the BSP did, namely the off cycle 75 and the 75 that was announced 2 weeks ahead of the meeting.
Thank you, Governor. We are down to our last two questions. First, from Ramon Melchor Tejero. This is a Facebook question. Has the BSP considered potential power and water rate hikes in its inflation forecasts?
Okay, I think the Francis should answer that. What's already in the forecast and what's still outside the baseline?
We have in the risk scenario, we have uh, uh, possible higher impact of global food prices, additional transport fare hikes, and higher prices of fruits and vegetables, as well as non-extension of EO 171, higher sugar prices, and of course, on the downside, lower world economic growth. So I would say that that has not yet been included in our risk matrix.
What are those higher electricity prices
Electricity prices
and what's the other one is mentioning?
and uh,
What's the other one?
water utility.
Water rates.
Yes.
Water rates. Hmm. So they're not yet
But
part of the baseline.
but we've included some adjustment in power rates
Yes.
next month for next month.
So for
in the
next month,
baseline.
they will be either in the baseline or in the upside or downside
Mhm.
elements.
Yes, Governor.
Thank you, Governor, and thank you, DG. This is the last question from Lee Chipongyan of Manila Bulletin. Governor Medalla, what is the latest GDP and foreign exchange assumptions of the Monetary Board to guide your monetary policy directions? We understand the BSP does not have a peso target, but you have an in-house exchange rate assumption that is not matched to DBCC assumptions sometimes.
Well, our models do not really use assumptions in this case. In fact, in this case, the growth rate is actually generated by the model, right? And to some extent, the exchange rates are also generated by some equations in the model. And for that reason, if I were a betting man, I will not use it because the history of econometrics is full of examples where an econometric model that is not guided by its owner is always inferior to the one that's guided by its owner. Meaning, what makes the model better is maraming add-ons yung owner ng model. Kasi napakahirap ipasok lahat ng nuances ng financial markets. So that's the reason we do not broadcast to the public what the resulting exchange rates and GDP are that comes out of our model that produces inflation forecast. Because these models are largely created to make inflation forecasts. And my own experience as a user is absent supply shocks, the models are quite good. So in other words, every time inflation is much higher or much lower than the model forecast, there is a very good explanation of what happened. By the way, let me emphasize that. There were times when the forecast was much higher than actual because I think those were 2 years where it's below 1 and then 1 about 1.5. I cannot remember now whether that's 2016 or 2015. And that was largely because global prices were very low. Okay, so those things are very hard to forecast. So I'm quite happy with the models that we have. And when they failed to forecast, it's very clear why they did, which is there was some large supply shocks, sometimes positive, sometimes negatives, that were really very hard to forecast. Of course, we should continue to improve our modeling, and we are actually doing that.
Since there are no more questions, we would like to thank everyone for their time and attention this afternoon, including those watching us live on Facebook. Also, we would like to remind everyone that the Monetary Policy Report will be available on the BSP website tomorrow, the 18th of November, 2022. This ends our monetary policy stance
Yeah,
and monetary policy report press briefing. Maraming salamat po and keep safe.